Okay, we're beginning a new reading, reading 17, and this is on employee compensation, post-employment, and what do we got? Share-based compensation. The share-based stuff at the very end, really, that's maybe 20 minutes. It's really quick. It's quite simple, actually. The pension stuff can get a little thick, but it's pretty straightforward as well, so I think we can walk through this chapter nice and easily. So let's have a look at the different types of plans we have and the different types of reporting we have for that. The easiest one, and really the more common one these days, is defined contribution. And that's exactly what it is. The contribution that the company makes is defined. Not the benefit, but the contribution is defined, which means the pension expense each period is easy to figure out. It's whatever the contribution is, right? It is a specific, agreed upon contribution made to an employee's pension plan. The employer's contributions are defined, the employee's benefits are not. So as far as accounting goes, this is really easy. And as far as analyzing after, if it's defined contribution, we don't have to do a lot of adjustments or look in a lot of places. It's one line item. That's great. The employer's contribution equals the pension expense. No further obligation. Nice and clean. And the contribution is made generally in the period in which the employee provides service. So if you work for the year of 2016, your employer will make contributions to the plan throughout 2016. At year end of 2016, those contributions are the expense. The only condition under which there would be a liability is if the employer has not made all of the contributions by year end. So let's say there's a pay period that spans 2 weeks and the year end is right in the middle of that week. Well, there would be an accrued liability for 1 week of contribution, but that's just a closing entry to close out the year. But there's no real carrying obligation beyond just those little things. The amounts paid are usually attributed to specific individuals as opposed to just a plan. When we look at defined benefit, while each employee has a specific obligation, the assets are not attached to any individual, but the assets in a defined contribution plan are attached to specific individuals. The future value of the assets of the plan depends on plan performance, and all gains and losses accrue to the employee. So there's a sort of a benefit to the defined contribution that if it does really, really well, the employee gets all of that. But in a defined benefit, if the plan does really, really well and exceeds all expectations, the company can actually recover some of that money and actually lower its pension expense because the assets, the plan, belongs to the company and not the individuals. All right, let's look at the defined benefit. This one here will occupy most of our time. It specifies the benefit the employee receives. The employer's contribution is not fixed in this respect. And every year that an employee works, it creates a future obligation based on current service. So you can start to see from an accounting perspective how difficult that would be. It's like, well, you've worked this year. There is some future obligation I owe you for the work you did in this period. So if I'm going to match expenses in the period incurred, that future obligation has to be matched to this expense. Oh boy, am I going to need a lot of assumptions. And we do. We're going to see that we need a lot of assumptions in here. The entitlement to the benefits increase with the length of the employee's service. So let's take my pension plan, for example. It's a defined benefit. I get 2% per year of service based on the average of the last 5 years of my salary. So that my future obligation that the institution owes me is based on some future expectation of what my salary will be at that point in time. And as I work the second year, I don't just get 2% now I have 4% of that final year salary, or the final average. If I work 3 years, I get 6% of that. So the obligation to me increases with more and more service. A note I made on the last screen, if we're talking about a defined contribution plan, the employee is the beneficiary. The employee is the beneficiary of that plan, so whoever is managing the plan, the company may be the sponsor, but whoever is managing the plan, whatever company is managing the plan, is managing it for the beneficiary, for the employee, and has to make decisions appropriate for the employee. For the defined benefit plan, the employer is the beneficiary. So it's the assets of the plan belong to the employer, because all the employer is saying is, look, at some future point I'm going to give you an obligation. And I'm going to put away money today to meet that obligation. That money I'm putting away it goes into assets, hopefully, that will grow to meet that obligation. But the obligation to pay those future benefits is the company's obligation to pay it. It's not the plan's obligation to pay it. The plan is just to say, look, I got to put away money to grow at a certain rate to meet these obligations, so let's set up this pension plan to do it. But the employer really is the beneficiary. The present value of all the future benefits that the employees receive, or the future obligations that the company has to incur, they may be 20 years in the future. You would present value them. That is the current obligation. That if the company could put away that much money and it could grow at a specific rate or some assumed rate, it would meet that future benefit. To do that, the company puts away money into a plan, and the fair value of the plan assets is the offsetting asset. So at any given time, there is a current obligation representing the future value of everything they got to pay in today's dollars. And then on the other side of the ledger, there's all of the money they put aside that will grow towards that future value. So if you have a present value for the current obligation, the present value for the asset is just the fair value of it. You can compare them and see whether you're underfunded or overfunded at this point in time. So as I said on the last screen, if the plan assets are greater than the current obligation, that's the present value of the future obligation, we call that the current obligation. If the plan assets are greater, the plan is overfunded. Now, it may be possible for the employer to recapture those funds, either by reduced future funding, because I'm overfunded, maybe next year I don't have to contribute as much, right? Or reversion of the funds back to the company. Typically, it's number one that is chosen. Be aware that this may happen when you have an overfunded plan. So when a plan is overfunded, what does this look like? It looks like there's an asset giving future benefits. That's the definition of an asset, right? Well, all assets have to be listed at the present value of all those future benefits. So we're going to see later on that when a plan is underfunded, you have to list the amount of the underfunding. When it's overfunded, hang on now, you can't just list the amount that it's overfunded. You have to list the present value of the future benefits that the asset adds. So there's a little bit of a trick when it comes to listing the pension asset if it is overfunded. The expense to be recognized each period is not the same as the employer's cash funding contribution. You can sort of think about it this way. Let's say that I buy a piece of equipment for $100,000 that's going to last 10 years, and I depreciate it by $10,000 a year. That's the expense that I recognize. But how I fund the purchase of that asset is not my expense. That has nothing to do with how I recognize the expense. It's the same here. You're going to have pension expense each year. Beyond that, you're also going to have your contribution that you make towards the plan. And the expense is not the employer's cash funding contribution. They might be equal, but it is not. Just we're going to revisit that later. We have to rely, or companies have to rely on actuaries to determine the level of the funding each period. And we're going to see why actuaries are important, because there's a whole bunch of assumptions in there. The companies really aren't in the position to start making a lot of these assumptions. So we have the use of what are called actuarial assumptions. It's not the company's assumptions. An actuary steps in and says, here's the list of assumptions we're going to use. Mortality rates, employee turnover, interest rates, earnings rates, etc. There's a whole bunch of assumptions that go into determining what the funding obligation is each period. And finally, beyond just the pension plans, the defined benefit and contribution, there are other post-employment benefits. We'll just shorten it to OPB. Health, life insurance premiums, etc. We won't spend a lot of time on these. Typically, they're classified as DB, defined benefit plans, which means they have similar accounting, but they do not have similar funding requirements. Company funding requirements may not be as stringent for the other post-employment benefit plans, and they typically do not pre-fund these plans. For a defined benefit, because it falls under a pension, the definition of a pension plan, every country has very tight regulations about how those are to be treated and how they're to be funded. So a company doesn't really have a choice. It's got to follow the law for the most part in funding those plans. But the OPBs, they don't fall within that purview. They fall outside of that. So the company says, hey, listen, if we don't have to fund it, let's not fund it. All right, let's move on to learning objective B here. Here's the deal with this is I'm going to give you a one-person plan, a one-person pension plan example for maybe a couple of years of employee service, just so that with all the language we're going to use and all the different terminology, let's have it clear in our heads what we're talking about as we move forward, because this chapter is not written to teach you about pension obligations. It's written to remind you about something you probably already learned somewhere else. At least that's the assumption made in writing it, because it's written in such a way that if you don't know what's going on, reading this chapter isn't going to help you figure out what's going on. It uses language in such a way that you already know what they're talking about, and they're just reminding you. So let's have a look here. The pension obligation, there's a big word. Let's make sure we understand what that is. That's the present value of the future benefits earned by employees for service provided to date. So if an employee works for 1 year, there is a certain obligation that's owed so many years in the future when that person retires. Well, that obligation will have a certain life. Maybe you'll have to pay for 12 or 13 years, depending on how long the employee lives. But it'll have a present value today. That's the obligation today. IFRS calls it the PVDBO, the present value of the defined benefit obligation. GAAP refers to it as a PBO, a projected benefit obligation. And from here on in, we're just going to call it a pension obligation. So let me set up a scenario for you here. I've got the timeline out, and I'm going to take just a couple of screens, and we're going to walk through some very simple calculations, very simple. But in doing that, the language and the vocabulary will become much clearer. Let's say it's January 1st, 2013 today, and Lee, who is 30 years old, gets hired for $37,500 a year. Lee plans to stay with the company for 35 years and retire on December 31st, 2047 at the age of 65. Lee expects that, and the company expects that every year there'll be about a 4% salary increase per year, so that in the final year, Lee will be making $150,000 per year. Let's note that this 37.5 is from January 1st to the end of the year, so the whole first year is this one amount. The second year will be 4% higher, and then the next one will be 4% higher. So we don't just think that it'll be 4% higher over the year. It is that figure for the year before it goes 4% higher for the year, etc., etc. So this 150 is actually for the final year. All right, there we go. And then he's going to retire, and there's a life expectancy of 12 years for Lee after that. He'll live to 77, then he's dead man. At least that's the thinking by the actuary. The benefit that Lee will be getting is 2% of his salary at retirement. At retirement, he'll get 2% of his salary for each year of service. And so it'll be 2% of the final salary times the year of service. Now, you'll see a little bit of an issue here, and this is a sort of a debate in accounting for this, is some people say, well, listen, he only made 37.5 here. If he quits here, if he stops right here, we're not going to give him 2% of 150. He's earned 2% of 37.5. Shouldn't we account for it that way? And then the next year, if he's got a higher salary, we'll use 4% of the higher salary. Then the next year, if he's got a higher one, we'll use another higher one. That is referred to as the accumulated benefit method, and it is not the method adopted by IFRS or GAAP. IFRS or GAAP adopt what's called the projected benefit method, which means you must use the projected salary. So that's why we have to go all the way out, even though we don't know how long Lee will be working. That's another assumption that has to be made. So the benefit that we calculate, the 2% of salary at retirement for each year, is 2% of the final salary times the amount of years of service. Now, what I've done here to highlight to you how critical our assumptions are, is I've labeled some of our assumptions we're making in this simple model. I've labeled some of our assumptions in green. The salary increase will be 4% per year. You'll be working 35 years. Life expectancy of 12 years. If any of these things change, well, we can leave the 35, but if the 4% were actually more, what if there's wage inflation and Lee becomes important and could get a job somewhere else? We're going to have to match that salary. We might have to get more aggressive with salaries in the marketplace. What if it's a slack labor market and we don't actually have to meet the 4%? What if inflation is very benign? Look at the situation we have in the world today, is that we don't seem to see inflation anywhere else. Which also means there's no wage inflation. And without wage inflation, it's hard to get increased consumption. That's why we have such lackluster growth around the globe today, is that this is really underperforming. That helps a company. That helps with all of their pension obligations, because if this ends up being 3%, guess what? This is not 150 anymore. This is some lower amount that you're getting 2% on, right? So this is a critical assumption. Life expectancy, 12 years. Does that make sense? 77? That's a young age these days. It's not uncommon for individuals when they retire at 65 to get all the way to 80, 85, even 90. So if 12 years goes to 13, 14, 15, 16, remember, it's defined benefit per year. So be aware of where we make assumptions, and later on we'll look at some assumptions made by some companies, and we'll determine the effect that they would have on the pension obligation. All right, so let's say Lee has worked for 1 year, and Lee's the only person who works for this company. At the beginning of the period before Lee was hired, there were no pension obligations, no anything. So let's see what happens after 1 year. We're going to need some discount rate, so we're going to assume 6%. It's not realistic in our environment, but it's just an assumption to make a point, right? So let's say we're now at time equals 1. We're not at t equals 0. 1 year has passed, so we're looking for PV1. What is the present value of the future obligation? Well, at t equals 35, our annual pension benefit is 2% for every year of service times our final projected salary of 150, and there's our 1 year of service. So it's 0.02 times 150 times the number of years of service. It's $3,000. The company owes them $3,000 a year in retirement for 12 years. So what is the present value of that? Well, we can think of it as a bond with a future value of 0, right? The payment is $3,000, the discount rate is 6%, future value is 0, our N is 12, present value is 25, 12135, but that's PV35. We want to bring it all the way back to PV1. So PV35 divided by 1.06 to the power of 34, because we're already 1 year in, is 346868. So that is our pension obligation. So for the current year, we should record as a pension expense for this individual $3,468.68. And that would be our pension expense. Let's be clear. This pension expense is based on 3 big assumptions: a consistent wage increase of 4% per year over 35 years, a consistent discount rate of 6% from t equals 35 to t equals 1, and a life expectancy of 12 years. So it's based on assumptions. Let's be clear about that. So our current service cost is $3468.68. Let's jump to the end of year 2. This is where we start to introduce other components of the pension cost. In the first year, it's all we have is service cost. After that, we start to have different expenses. So let's have a look. Now we're at the end of year 2. At the end of year 2, we owe another $3,000 for each year. You may think, well, shouldn't you be putting 6s down? No. I'm only counting the cost for year 2. This is this current service cost for year 1. We just want the service cost for year 2. So all we want to do is figure out what is owed in retirement for that 1 extra year of service. On the next screen, I'll show you what the total obligation is. But from year 1 to year 2, Lee worked another year, is going to get another 2% of the 150 for another year. There's our $3,000 again. Present value of 25,15153. It's the same thing. But notice now when we discount it back, it's only for 33 years. Our service cost just increased. That's what we said earlier when we talked about defined benefit, is that the cost of the plan, the benefit obligation, increases with every year of service because you're discounting back a consistent present value. No matter how we do it, each year it'll be the same present value per year, not combined, but per year. Here we're going back 34 years, then 33, then 32, 31, 30, 29, 20, etc., etc. So you can see that the pension obligation, the current service cost that goes into the pension obligation, is going to increase year after year, 36.76. So in year 2, not only are we paying him more, not only are wages and salaries expense higher in year 2 than they were in year 1 by 4%, but the pension component of it is also higher, 36.76.81, and it's higher by how much? Well, the discount rate, right? If we would have went back one more year, we would have discounted at 6%, which means moving forward must be 6% higher. All right, let's have a look at the end of the 2-year period now. So now we're going to look at it on a cumulative basis. What happens from the time that Lee was hired to now, not just on an annual basis? Well, he's completed 2 years of service, so we owe him $6,000 a year. We figure he'll live 12 years. If we take a present value of this $6,000 12-year annuity, we can use a calculator this way. We'll get $50,303. Let's bring it back to PV2, or time period 2. We're discounting at 1.06 to the 33. That's $73.54. So we have a pension obligation at the end of year 2 of $73.54. But we calculated the pension obligation at the end of year 1 as $34.69. And at the end of year 2, we said for year 2 it was $36.77. That only adds up to $71.46. How did we get to $73.54? Well, when we discount back, what we're implicitly saying is that if we're discounting back at 6%, we're saying that whatever we owe, we're going to put this money aside in a plan that's going to grow to this future obligation. Well, it has to grow at the discount rate. It has to grow at 6%. So this, we have to take the first year, multiply by 0.06 for 208, and add the 208 to the 7146. There's our 7354. So that's the second component of pension expense, is the interest that we have to pay. Now, I know what some of you are thinking out there. You're saying, yeah, but the plan assets are growing at the same, are growing, right? I mean, you're not just putting it in cash in a drawer and saying, well, every year we'll throw interest in there to make it equal. You're investing in assets that are growing, right? Yes. Yes, we are. And we're going to see that we net that out. But we must record it as part of the expense, because it is. Any gains that we get or any expected return we get on our assets will offset that. You have to have a separate entry for every separate thing that you're doing so that you can track the performance of everything. So step 1 is, yes, we have to recognize explicitly there is this interest cost because this money has to grow towards this obligation. That is our responsibility. If the assets we invested in do the heavy lifting for us, great. But we're not going to make that assumption. We're going to go ahead and put it in. So $73.54. So if we look at what year 2 pension expense would be, in year 1 it was $34.69. In year 2 it's $36.77 plus $208 of interest on the outstanding pension obligation, which means it's $38.85 in year 2. Where do we get the R, by the way? We should make a note of that. The interest on the outstanding obligation, by the way, is R. Our discount rate was 6%, and the interest on the obligation is 6%. That's an IFRS thing, that the interest rate equals the discount rate. And the rate that we use is the current market rate on investment-grade corporate bonds. So, to sum up, our pension obligation at the end of year 2 was $73.54. Our plan assets, let's say that of all the money we put aside, our assets at the end of year 2 are either $8,000 or $7,000. If it's $8,000 and we have a pension obligation of $7,354, we have an asset because we just net them. The pension obligation does not show up on the balance sheet, and the plan assets do not show up on the balance sheet. The plan assets really are separate. They're in a separate entity altogether, so there's no consolidation on the company's balance sheet of all of the plan assets. You'll find it in the footnotes or in the notes to the financial statements, but you won't find it listed on the balance sheet. All we'll find is either a net liability or a net asset. In this case, we would have a net asset of 646, potentially 646. We'll see that maybe it might not be the full asset, because remember, we must use the present value of the future benefits of this asset. So even though the actual number is 646, the present value of that may not be equal to 646. And if it's 7,000, we're 354 shy. Well, that's a liability. We list the whole amount unadjusted. So what we'll find on the balance sheet is just the difference between what the obligation is. We've already seen how we arrive at this obligation. We've seen two of the cost components, the current year service cost and the current year interest on the outstanding pension obligation. We're going to add more to that, by the way. It gets more complex, but step by step, right? So we create an asset or a liability. Great. Let's look at another potential cost or benefit. It's called an actuarial gain or loss. An actuarial gain or loss. Remember, our assumptions are called actuarial assumptions. So, how do actuarial gains and losses arise? They result from, number one, a change in assumption. Perhaps over a given year, the actuary comes back and says, based on evidence, we got to change this life expectancy from 12 years to 14 years. Well, that's going to result in the amounts that we've recognized so far as being too low. So our pension obligation suddenly will be higher. Well, that is an actuarial loss, because it results, we have an increased liability as a result of a change in assumption. So that's an actuarial loss. Results from a change in assumption and an experience gain or loss. Now, what's an experience gain? This is the difference between actual versus estimate. So we're going to see that the actual return on plan assets versus the expected return, that difference between there is an actuarial gain or loss. Now you might be thinking, but that doesn't jive. Why wouldn't you just use the actual return on the plan to offset the pension obligation and know exactly where you stand? Okay. Here's the counter argument to that. Well, look, we're going to be doing this over the next 35 years, and from year to year there's a lot of fluctuation in the market. So there'll be years where we have the actual return will be greater than what we need, and there are times where it will be less, where we'll actually lose money. It is wiser over the long term, if we're trying to allocate these costs to each period. It is unfair to say, well, in this period, because the market performed poorly, your expenses are higher, but in this period, because the market performed well, your expenses are lower. Meanwhile, in each period, you had the same employee service. So what the actual method is to say, let's take the long-term expected return on the market, and we'll use that each year as the expected return. Any difference between the actual and estimated we'll call an actuarial gain or loss. That'll be called an experience gain or loss. And it'll show up in a different part of the statements. And we'll get to that. Sometimes it's nice to know what the road ahead looks like so that when we get there, we'll recognize the signpost, right? Just to give you another heads up, we're going to do some changing on the assumptions, but let's just change one now. If life expectancy increased 1 year to 13 years, let's say Lee is not going to live 12 years, but we'll put him up to 13 years, 1 extra year. The pension obligation would be $77.65. For those first 2 years would be $77.65. Notice up here, at the end of year 2, we're at $73.54. 1 extra year, 2 years in, look at the difference. $77.65 minus $73.54 is $411. So this pension obligation is $411 higher because of this change in assumption. Because we don't know if he's going to live the extra year, the actuary came along and said we need to change it to 13. That's a change in an actuarial assumption. This is called an actuarial loss. It's not called a part of the pension expense. We put it in other comprehensive income. Now, it is part of the overall pension expense, but it matters where on the statements we put it. This is going to show up in OCI. Now, the reason it's going to show up in OCI is because it's expected that over time, the actuarial gains and the actuarial losses will tend to offset each other. So rather than making the net income component volatile, we'll stick it in OCI. Okay, so let's start looking at our component costs now. And we've introduced the language, so we should be able to go quickly through these screens now that we see in our heads where it all came from. We can get right to it. For defined contribution, there's only one cost. It's whatever contributions were made during the year. It's reported as an expense on the income statement. There is no balance sheet effect. Now, that's not entirely true, that there is no balance sheet effect. If we are a manufacturing company, our manufacturing employees, their total compensation is part of direct labor, which is included as a component of the final good, the inventory, so that the pension expense would be folded into the cost of the inventory. Hence, if we had inventory sitting on our balance sheet, in the cost of that inventory would be the pension expense. So, when we say that there's no balance sheet effect, there is no direct balance sheet effect, but if it's folded in to the cost of our product that we make, then it technically is sitting on the balance sheet. Technically it is, and it's expensed as cost of goods sold when we sell it for a manufacturing concern. But if we have nothing like that for the defined contribution, it simply shows up on the income statement as an expense. It's gone. There is no balance sheet account. For a defined benefit, the balance sheet shows the funded status on the balance sheet. So remember, I said we don't show the pension obligation as a liability, and we don't show the pension assets under assets. We show the net. And the net tells us the funded status. That's on the balance sheet, and it'll either be an asset or it'll be a liability. So we take the pension obligation at the end of the period. So for our example, at the end of year 2, we had a pension obligation that we had to deliver some 33 years from now. We had the present value of it. And we subtract the fair value of the plan assets. And that will give us our funded status. If the pension obligation is greater than the fair value of the assets, we have an underfunded pension, which sets up a net pension liability. So when we're looking at a company's balance sheet and we see a net pension liability, right away we know that they have an underfunded pension obligation. If the pension obligation is less than the fair value of the assets, we are overfunded, which sets up a net pension asset. Now, it is subject to a ceiling because it is an asset. And remember, what is the definition of an asset? It is something that provides future economic benefits, so that the asset should be listed at the present value of those future economic benefits. I've also said earlier that if we have an overfunded pension, it may be possible to get value out of that by either reduction in future contributions or reversion, fund reversion back into the company. But let's say that we're going to do the reduction of future contributions. Over the next 3 years, we're going to reduce our contributions. Well, all of a sudden that asset now is spread over the next 3 years. We would have to present value that. That is the ceiling at which we can list that asset at. It's the present value of future refunds and reductions. So to give you an idea how that looks, let's take two companies, ABC and DEF. Look at their pension obligation and the fair value of their plans. ABC is 6723 and 4880. We can see their pension obligation is greater than the fair value of their plans. That would give them a net pension liability of 1843. That's straightforward. DEF is 5485 on their pension obligation, 5998 on their assets. We can see that the assets are greater than the obligation, but this 5998 is subject to a ceiling of 326. So that it has an asset ceiling of 326. We don't have to know how that ceiling is calculated. We don't have to get involved with it. We don't have to understand the accounting of it at all. We just have to understand that when it comes to the asset, it may be restricted by a ceiling. It will not show the full value of the asset today, but it'll show the present value of future refunds and reductions. There may be a ceiling. So even though the difference is greater than 326, our net pension asset can only be 326 because we've hit that ceiling. All right, so let's list our periodic pension costs, and we'll do it for IFRS and we'll do it for GAAP. And in doing it for IFRS and GAAP, we'll notice the difference. We'll pay attention to the difference in the way that it's accounted for, number one, or I shouldn't say accounted for, but the difference in the way that it's measured and recognized. How's that? So there are three components for IFRS. There's the service costs, which we've explained. There's the net interest expense or income, which we've explained. And there are remeasurements, which we've explained what the remeasurements are, the actuarial gains and losses, etc. So let's start with service costs. Current and past service costs. Now, I've only gave you an example of a current service cost. A past service cost would be this way. Let's say that you've worked for me for 2 years and you decide that you want a union, and you get a union. And part of the deal of the union is that I must recognize the previous 5 years of service before I implemented the plan. So the plan's 2 years old. You've been working for me for 10 years, but only for 2 years have you had a plan. You get a union, the union's successful, and saying, look, buddy, they're giving you 10 years. You've only done this for 2 years. We get it. You're a nice guy. You're trying. But let's add another 5 years for past service that they did. Well, I may have to agree to that. Well, that's called a retroactive benefit. The word benefit now applies to the employee, not me. A retroactive benefit costs me money. So current and past service costs, this is a past service cost. However, it might be a situation where I've had a plan in place for 10 years and the union comes and says, we want this, this, and this. And I say, excuse me, Mr. Union guys, have a look at the global world we live in. I can go anywhere. I can go to China. I can go to Mexico. But I can do anything I want. So I tell you what, I think I'm giving you too much. I want some of this stuff back because I can't survive here unless I get it back. That's called a curtailment, a retroactive curtailment. While a retroactive benefit for the employee is a past service cost for me, a retroactive curtailment for the employee is a past service benefit for me. So let's be careful where we're using the word benefit here, right? When we say a retroactive benefit, that's the employee's benefit. It's my service cost. If it's a retroactive curtailment, that's the employee's curtailment. I'm curtailing them. That would be my past service benefit. No matter how it comes about, current and past service costs / benefits would be recognized in P&L. Boom. There we go. That's nice and neat. That's simple. It's recognized in P&L. Let's move on to the next one. Net interest expense and net interest income. Our net pension liability or asset times the discount rate. That's how easy that is to figure out. Here's how it works for IFRS. It's 6% on either side. So we have our whatever our pension obligation is at the beginning of the year, we multiply it by 6% to get our interest expense for the year. Then we look at our plan assets at the beginning of the year and we multiply that by 6% to get our interest income for the year. Well, if you net those two out, all you're doing is multiplying either your net pension liability or your net pension asset by 6%. This only works for IFRS. Well, I shouldn't say it only works for IFRS. It always works for IFRS. It may work for GAAP if the interest expense equals the expected return on assets. GAAP can use two different numbers. IFRS says, hey, whatever your interest expense is on your pension obligation must be the same expected return on your plan assets. And whatever this comes to, recognized in P&L. So far, so good. Nice and clean. All the expenses are recognized in P&L. Let's move on to remeasurements now. This is our actuarial gains and losses. An actuarial gain and loss is a change in assumption that results in either us having less of an obligation or more of an obligation. Remeasurements also include differences between the actual return on plan assets and the net interest expense or income. So, let's say that we have plan assets that we expect to grow at 6%. That's included in here. But let's say they actually grew at 10%. We do not change this. This still will continue to go forward based on the expected return. That 10% is greater than the 6%, shows up as a remeasurement called an experience gain. And it's in OCI, other comprehensive income. And the reason we're doing that, as I explained before, is that, well, in the next period, you might underperform the 6%. And then in the period after that, you might overperform, then underperform. So it's expected that many of these, if we take a long-term view of the market and we say, look, over the long term, we should expect 6% per year. It may do this in getting there, but because that's the business cycle, right? So rather than having your net income fluctuate like that, let's do the long-term rate, and anything extra gains will typically be offset by losses at some point in time. Let's stick them in OCI to reduce the variability in net income. How does that sound? Well, actually, the industry said, yeah, that sounds great, and well, there it is in IFRS. And one final point before we go. IFRS uses something called the immediate recognition approach. That means that in each period, whatever costs there are, your service costs, your current and past, any net interest, income, expense, or any remeasurements are recorded immediately right where they are. So everything in current and for service costs goes into P&L. Everything on net interest, income, and expense goes into P&L. That's called immediate recognition. Now, you may say, but yeah. Well, the reason I pointed out now is to show you the difference with GAAP. GAAP doesn't use that, sort of. All right, let's look at GAAP. GAAP has the same categories, the same components of pension cost, service cost. Down here we will have a net interest expense or income. I'll explain why it's on 2 lines shortly. And then remeasurements. They're not really called remeasurements, but I just want to keep the same headline just so that you can compare it with IFRS, and that's not really far off. The big difference here is GAAP has something open to it called the deferral and amortization approach. Now, it's sort of a combination of immediate recognition and deferral and amortization. Here's why. If you're a GAAP reporting company, you can choose immediate recognition. You can go ahead and do that and be comparable with IFRS companies. But you have deferral and amortization open to you, so you may as well use it because it only benefits you. Why would you give it up? So it's typically used, so we should know what it is. And it affects all 3 categories. Let's look at service costs. Current service costs go straight to P&L, immediate recognition. Same with IFRS, great. Past service costs go to OCI first and then are amortized to P&L later. Well, what's the argument here? They go to OCI in the period giving rise to the cost, but then they're amortized to P&L over the average service lives of the affected employees. And the rationale is this. Look, okay, it's this year. We have this past service cost that we'll recognize, Mr. Union Boss. Here you go. See how good we are. But listen, it's kind of unfair for us to recognize this whole expense in this 1 year. So what we want to do is make it a little bit more reflective of the obligation that we have. It is some future obligation that we've only recognized today. So let's amortize it over the average service life of these affected employees. If they're going to be here another 10 years, let's amortize this cost over the next 10 years to better reflect matching. And a lot of people said that makes a lot of sense. Oh, let's do that. The IFRS used to allow that, by the way, I think up to 2010, 2009, 10, 11. If anyone knows the exact date, please put it in the comment box below. I think up to that date. I'm not sure. But anyway, they used to allow it, not anymore. So it's amortized. So there's one big difference in service costs, is that you can defer the past service cost component and amortize. That's why it's called a deferral and amortization approach, right? Let's look at the net interest expense. To our periodic pension costs, we add the interest expense. This is the discount rate, whatever discount rate we use, times the pension obligation. And from that, we subtract the return on plan assets. That is an expected return. In IFRS, these are the same rates. So you can net the two out. You could just take, you don't actually have to do one calculation and then another and then net it out. You could just say, look, whatever the net pension liability or the net pension asset is, multiply that by whatever the discount rate is, you got it. With GAAP, they say, well, hang on a second. The pension obligation may have one rate that we multiply it by, and the assets may have another rate. So there are 2 different line items. They are not presented net. They are 2 separate line items. For IFRS, they hit the P&L net. Here, they do not hit the P&L net. The interest expense will show up in one line. It'll show up not as a separate line item just for this, but it'll show up with all other interest expense in that number. And this number will show up in all other interest income, but they will be in different line items on the income statement. They go to P&L. They're not presented net. So now for comparability, you gotta pull these apart. We'll talk about that as we go through some of the later learning objectives. Remeasurements. Here, the actual versus expected returns are treated as actuarial gains and losses. They're not called experience gains and losses. They're treated as actual gains and losses, and they go to OCI. Now, that's the same with IFRS. It goes to OCI, but IFRS says it's never amortized to P&L ever. GAAP says it goes to OCI, but under certain conditions, it's amortized to P&L. So we've got three big differences here between IFRS and GAAP. GAAP will amortize any past service cost. GAAP will present two different line items because they can use two different rates, but IFRS doesn't. And GAAP will amortize some of this OCI to P&L under certain conditions. IFRS is never. So let's just spend some time getting our heads around this deferral and amortization and corridor approaches, because the reading doesn't give us a lot on it, so hopefully I can give you some background here. The deferral and amortization allows a company to delay the recognition of, as we've seen, past service costs or actuarial gains or losses in plan expense. Amounts not reflected in P&L are called unrecognized past service costs or unrecognized actuarial gains or losses. So we're introducing some vocabulary here. Anything that shows up in OCI is not recognized in P&L. It's showing up in OCI. All those amounts are called unrecognized past service costs, because we can do that for the service costs, or unrecognized actuarial gains and losses, because we can delay recognition of both. So they're unrecognized. And the reason this is done is to reduce period-to-period volatility in pension expense. IFRS has to put this in P&L. They have no choice. They can't amortize it. And for actuarial gains or losses, it all sits in OCI. So when you're comparing IFRS and GAAP, depending on the level of past service costs and depending on your actuarial gains or losses, if they're not offsetting each other, it's going to be hard to compare the two together. Some examples coming up will really highlight that difference. I know that words, when it comes to accounting, words don't quite make it, but there's some good examples that will show that difference. So let's talk about the unrecognized actuarial gains and losses. And I mentioned this before. These gains and losses are expected to offset each other over time. But what if no offsetting occurs? What if you have underperformance on your assets below your discount rate that you're using for your pension obligation year after year after year after year? You have actuarial losses that are building and building and building with no offsetting gains. Well, for IFRS, it says it all sits in OCI. It stays in OCI. You cannot amortize any of that to P&L. GAAP, on the other hand, says, well, now hang on a second here. That distorts net income, and actually, you know what? The company that's reporting it would rather not have to amortize it, but there is an amortization saying, look, if it builds up to a point that's just ridiculous, you got to start recognizing that as an expense, because it's a real cost the company has to face at some point, and leaving it in OCI as an unrecognized pension cost doesn't make a lot of sense. You got to start recognizing some of this cost. That's called the corridor approach. All right, so let's talk about this corridor approach. It's used when the unrecognized actuarial gains or losses continue to grow. In other words, no offsetting is occurring. It's amortized to P&L when the balance grows too large. So at the beginning of a period, if the net cumulative unrecognized actuarial gains or losses, lots of language here with accounting, right? What this is saying is that if the total amount sitting in OCI, or accumulated OCI at this point. Sorry, OCI is only for the year. Accumulated OCI is what we accumulated in. If the net cumulative gains or losses are greater than 10% of the larger of either the pension obligation or the fair value of the plan assets, only the excess is amortized over the expected average remaining working lives of employees in the plan. Aren't you glad that there are accountants that have to deal with all this? We just have to know the impact on the financial statements. We don't actually have to do the transactions for all of this, right? Let's have a look at what that looks like in an example, and you'll see it'll clear up then. Words, again, are sort of unsatisfying. All right, let's look at an example of this corridor approach. So let's take 3 years, 2013, 14, and 15. We have our pension obligation at the beginning of each year, 2.1, 2.6, 2.9. Our fair value of the asset at the beginning of each year, 2.6, 2.8, 2.7. For the year, we've experienced actuarial gains or losses of 400, 300, and negative 170. So, first step is to calculate the corridor amount, and it's the 10% of the larger of either the pension obligation or the fair value of the assets. So which one is larger? Well, the fair value of the assets are 2.6, so 10% of that is 260. Here we have 2.6 and 2.8. 2.8 is the larger one, 10% is 280. And here we have 2.9 and 2.7. 2.9 is a larger one, 10% is 290. So let's calculate this now. Let's do some calculations. So 2013 corridor at the beginning of the year is 260K. The unrecognized gain or loss at the beginning of the year is 0. We're assuming that this happened during the course of the year. So any unrecognized gain or loss at the beginning of the year is 0. Amount to be amortized is 0. Amortized, we're getting in this example, we'll assume over 5.5 years. Our actuarial gain or loss for the year, this one we want, is 400. So any unrecognized actuarial gain or loss at the end of the year is now 400. Great. Let's go into 2014. What's our corridor here? 280. What is the unrecognized gain or loss at the beginning of the year? It's 400. What is the amount to be amortized? B minus A. B minus A. 400 minus 280 is 120. Remember, what we're amortizing here is any amount of the unrecognized gain or loss in excess of the corridor, in excess of 10% of the greater of these two things. The greater was 2.6 million, which was 260,000. For the next year was 280,000. We had a beginning balance of 400. So during 2014, we're going to begin to amortize this 120,000. Since we're doing it over 5.5 years, we'll amortize 21,818 per year. And the actuarial gain or loss for this year is now 300. So what is unrecognized at the end of the year? It is 400 minus the 21,818 because we've amortized it, plus the 300 gives us 678,182. Let's go into 2015. What is our corridor? Our corridor is set up as 290. What is our unrecognized amount at the beginning of the year? 678,182. And B minus A gives us 388,182, because anything over 290 we can amortize. So now we're going to amortize 388,182 over 5 years, which will give us 70,579 per year. So this becomes the new number now. And what did we have here? We had 170. So we have an offsetting number, right? So if we take 678 minus the 70 because we've amortized that, minus the offsetting 170 now that we have 437,603. So if the corridor next year were, let's say, 440, this would be the amount at the beginning of the year. When we go to amortize something, we would have 0 to amortize that year. So just because we start amortizing a certain amount doesn't mean we will actually see it all the way through. We may get some offsets that bring us below the corridor and hence cancel any further offsetting. This is really used when your unrecognized amount in OCE continues to build in one direction to the point where you say, look, we got to deal with this. You can't just leave it all there. We've got to tell our shareholders that this is a problem and start reflecting it in P&L. IFRS doesn't do that. Now, you may wonder, well, why does IFRS not do it and GAAP does do it? And it really comes down to the difference in how you recognize the expected gains and losses. IFRS uses the same discount rate as the expected return on assets. So remember now that discount rate is determined by the yield on corporate debt. So if the market yield is extremely low, IFRS says, well, that means the expected return on plan assets will also be reflected as extremely low. So they will offset each other because you won't have this artificially high bar to jump over. Whereas IFRS says, yes, the discount rate is the return on investment grade corporate bonds, but the expected return on the assets can be something else altogether. Well, then that sets up the possibility that you might have an expected return that is simply too high to get over. It's not a market-determined rate at that point. It's not tied to that corporate bond. So that because of that, you may run into this situation where offsetting is not going to occur, so the corridor approach is in there. To get rid of the corridor approach, you'd have to tell GAAP, look, your interest rate that you use must be the same as the expected return on your assets. Then you can get rid of it. Well, maybe they don't want to do that, right? All right, here's a table that's replicated from the textbook, just because I think it's a nice summary of IFRS versus GAAP. So we can see the three components here for IFRS: the service cost, the net interest income and expense, and the remeasurements, the net return on plan assets, and actuarial gains or losses. We can see recognized in P&L for service costs, net interest income expense recognized in P&L as the following: the net pension liability or asset times the interest rate, because it's the same on both, right? So you could just net it. Remeasurements recognized in OCI, and look at that, not subsequently amortized to P&L. Okay? Under GAAP, the current service costs are P&L, past service costs OCI, and subsequently amortized to P&L. Interest expense, P&L. Expected return, P&L. Now, these are separate because they can be different rates, so you can't just take the net. Actuarial gains and losses recognized immediately in P&L. It can be, or more commonly, recognized in OCI and subsequently amortized to P&L using the corridor or a faster recognition method. The corridor method is, if it's over 10%, you got to do it. That doesn't mean that's all you have to do. You can do it faster if you want to. It's more conservative. So this is a nice chart to refer to if you want to try to keep it straight. We'll revisit this later on. So now we're going to look at these actuarial assumptions in a little bit more detail and look at the effect that it has on the pension obligation. And it has a direct effect, and it has a kind of an indirect effect, that if we change an actuarial assumption, we do actually change one of the components of the pension cost per year. So an increase in our pension obligation can result from a change in assumptions. We would call that an actuarial loss. And if we decrease our pension obligation because of a change in an actuarial assumption, we call that an actuarial gain. And when the pension obligation changes, the interest expense changes, because remember, the interest expense is the net pension liability or the net pension asset multiplied by the interest rate. Well, if we change an assumption and we change the balance, the PO balance on which we're multiplying the interest rate on, the interest expense component changes. So this is a sort of a nice summary of how the pension obligation account is amended each year. We'll start with our beginning balance of our pension obligation. To that, we will add our current service cost, our current interest cost. We will then deduct all the benefits we paid, because if we have the obligation to pay them and we pay them, then they're done. We paid that much for that period of time. We deduct it. And then there'll either be a gain an addition or subtraction of past service costs or benefits, if there were any, and an addition or subtraction of any actuarial gains or losses to come up with our pension obligation at the end of the year. These are all of the assumptions that are built in to determining what the pension obligation is. There's assumptions about employee turnover, life expectancy, future inflation, interest rates, future compensation levels, rate of increase in compensation, long-term equity growth rate. So any of these things change, we have to change the assumptions. Those assumption changes are called, again, actuarial gains or losses, depending if it increases or decreases the pension obligation. All right, to illustrate a lot of these actuarial gains or losses and the effect that it has on the interest component, let's use a scenario right out of the curriculum. We have a 5-year employment horizon. The employee is currently making $50,000, and that'll be $50,000 for the first year. Every year there'll be a 4.75% increase per year. That's an assumption. So during the second year it'll be 4.75% higher, on and on. How we get to the 60,000 is it's 1.0475 to the power of 4. We don't do 5 because remember now, this 60,000 that we're getting to is for the start of the final year, not the end of the year. So we have one increase here, one here, one here, and one here. There's only 4 pay increases in those 5 years. Be careful about that. It's not that we're increasing it 5 times. You're only getting 4 pay increases over the 5 years. So that'll be our ending salary going in. And notice I do the calculation here. 50,000 times 1.0475 to the 4 gives us our salary in our final year. And let's say that our benefit is 1.5% of our final salary times the amount of years of service, and it's paid as a lump sum. So that when we hit 65, we're just going to get a lump sum payment, and what we do with that is up to us. Typically, we would, from a pension, we would transfer that into a registered retirement income fund so that it's not taxed coming out of the pension. Then we would determine what we would withdraw out of there, but we're going a little far afield. So here it is right here, 0.015 times our final year salary times our 5 years is $4,514.89. That's what we would receive as a lump sum. In other words, we would be earning $902.98 per year towards that 4514, which is this amount here. That's called an annual unit credit, where we just take, well, for each year, since the final salary pretty much stays the same as we calculated, and the percentage benefit stays the same, this 902.98 stays the same every year. That's our service cost every single year. When we present value that back to each specific year, that's where we get a differing service cost each year, the time value of money. But our annual unit credit is 902.98 in this particular respect. So let's have a look at what our pension obligation is given this scenario. At the beginning of the year, we got 0. 6% interest, well, there's no interest on 0, so it's 0. And the current service cost is $715.24. If we earn 902.98 as our annual unit credit, 902.98 at this point in time, bringing it back to this point in time gives us a discounted value of $715.24. So our pension obligation at the end of the year is $715.24, which becomes our opening obligation. Now, because we have an obligation, we tack on 6% interest. We get to $42.91. And then, of course, you discount 902.98 back only for 3 years at this point. You'll get $758.16. So there's our pension obligation at the end of the year. And you can just go through the years, and you can see that we'll get to the same $14.89 that we have here. That's our baseline scenario. Now we're going to start changing things. So make sure you understand this baseline scenario and everything that we've done here, because now we're going to start changing things and we're going to see what effect it has on our pension obligation. All right, we're going to make the same scenario. We're going to keep the same scenario, the baseline, but we're going to change something here. We're going to say that not only do we have the 5 years paid as a lump sum, but we have past service. We have 10 years of past service that we have to add on to this as well. So we know that our annual unit credit is 902.98, but now we're multiplying it by 15. The 5 years that we're going to put in plus the 10 years of past service, that's $13,544.68. If we look at our 902.98 and multiply it by 10 for the 10 years of past service, we're at 9209.80. If we divide that by 1.06 to the 5, we get 6747.58. What am I doing here? Well, here we are at this point in time. We need, what is our pension obligation at this point in time? Remember on the last screen, if there's no past service and we're just working these first 5 years, our pension obligation is 0. But now we have 10 years of past service. So the first thing we have to say is, okay, well, there's a pension obligation right out of the gate for those 10 years of past service. So what we do is we figure out what our annual unit credit is. It's 90298, and this would stay the same no matter what year you calculate this in. What changes is the present value of this amount depending on what year you're in. So for this 90298, we've earned an obligation at retirement of 9209.8, but today at our starting salary it's only worth 6747.58, so we'll put that in as our pension obligation at the beginning. Notice right away we get hit with an interest charge. So whenever we give past service, or whenever a company gives past service as a concession, let's say in a union contract they're going to give something as a past service concession, it's going to increase their pension obligation, number one. It's going to increase that liability, number one. Number two, it's going to increase the carrying cost of that obligation because suddenly we have 6% interest, whereas before we had no interest. So there's another 40485. You'll notice that this line is exactly the same as it was in the last scenario because every year we earn one more year of service, and since we're apportioning each year's of costs into that year, it's not cumulative per year, it is each year on its own discounted back. So as our employee moves closer to retirement, the service cost component of pension expense for that individual increases up to 90298 or 90297. I've rounded off here. So again, you just follow this through. We go through the same amounts. We get to 13,54468, which is exactly what we got. So we can see that adding some past service has two hits. Number one, it increases the liability quite significantly. Number two, it introduces an incremental jump in the interest expense that we have to recognize each year. All right, let's try a different scenario here. Let's go back to our baseline scenario. Our baseline scenario is in white, and this is the conclusions we reached at that time. We were building an annual unit credit of 90298 per year. Our total obligation for this employee at the end of 5 years was 451489, and they disappeared. Well, now the union has come in and said, you know, this one-time payment thing is not enough. Everybody has retirement benefits for every year of retirement. You got to start doing that. And the estimate for this employee here is that they're going to live 20 years, so we'll pay them 20 years of retirement payments on the same formula, 1.5% of the final year's salary for every year worked. That comes up with a total of $45,1489. That is their annual income in retirement for 20 years now. So we have a huge jump in costs for this amount. So if we took this $45,1489 and we present valued it, our payment is $45,1489 per year at 6% for 20 years with a future value of 0, gives us a present value of $51,785. So that's the amount of money that we have to have at year 5, $51,785, and if that grows at 6% for 20 years, it'll just meet that obligation. If we divide that by 5, because we have 5 years now that we have to apply it over, because we want to get to the new annual unit credit, we get to $10,357.09. For the lump sum payment, the annual credit was $90298 that we charged each year for service costs. Now we're charging $10,357.09 per year. Of course, discounted back to its appropriate year. So if we take this $10,357.09 and we discount it back and apply it to the first year, the second year, the third year, the fourth year, etc., here's what we get for the service cost each year. So that at the end of the first year, our pension obligation is $8,203, not the $700 and change we had before with a lump sum payment, but $8,200. Look at our interest cost component, 6%, and it starts to increase over time. So the interest component increases over time. The service cost component increases over time. So the longer an employee is with an organization, the more expensive they become on a pension expense basis until they retire. So adding the retirement payments each year, not just one payment, but a payment every single year, significantly increases the pension expense. Now, That being said, it is very rare, I shouldn't say rare, maybe for higher level employees it's quite common, but typically if you're in a defined benefit plan, you don't get to choose what your contribution is. It's simply just taken off your pay. You must make. You have a compulsory contribution that you must make to the pension fund, and the employer tends to match it. So that this 820375 doesn't all come from the employer. Some percent of that comes right off your paycheck. So I have a defined benefit plan where it's 2% per year of service based on the last 5 years average pay. But 14.3% of my pay disappears every paycheck. 14.3%. So I'm paying for quite a bit of my own future pension. So it's not so much as a benefit in that sense, because I am paying a large part of my own benefit. Even though we're looking at the total costs here, that does not mean that that is the employer's contribution in this regard. All right, let's get a nice complex scenario up here. Remember our baseline scenario. The second example we went to added 10 years of past service cost. Then for the third example, we went back to our baseline scenario and added 20 years of retirement service. Well, let's put all of it together now. Let's assume that we have 10 years past service, 20 years retirement benefit, the 6% discount rate. So we're getting 1.5% of our final year salary. That doesn't change. And we have 15 years, so we are building an obligation to the employee of $13,54468 per year. And just so that we understand where we are, this is where we are today. And this is our 10 years past service. This will be our 20 years retirement benefit, and each year we're going to get a payment of $13,54468 because we have 15 years of service in. So if we take a present value of this this annuity, that'll be a present value at time 5 is $155,35641. If we divide it by 15, we get $10,35709 per year. So we know that we're going to take this $10,35709 and we're going to discount it back to the appropriate year all the way back. But we're already here. So we need to know what the pension obligation is at this point in time. Well, if it's 10,357.09 per year, we simply multiply that by 10 because 10 of those years will be at that future value, which is this present value. And let's bring that back to this point in time. It'll be 77,394.23. Add our interest component. Add our service cost component. That should be a plus. Let me put that in. Add the service cost component. Our pension obligation at the end of the period is $90,24167. Now, let's change the interest rate. If we change the interest rate, we're changing the discount rate. So we're going to increase the discount rate from 6% to 7%. That's going to do two things. Number one is it's going to lower the present value of any obligation that we have. And any service cost component, it'll lower the present value of it. But it'll raise the interest expense per period. So let's do that. Let's bring it to 7%. But now we have to take the 10 years past service and bring it back to here to get the pension obligation at the beginning of this 5-year period, 68,205. Notice that we have a much lower beginning pension obligation. But we multiply that by 7%, we're at 47.76 on the interest cost versus 46.43. So 6% on a higher amount ended up being less than 7% on a lower initial amount. So we have a higher interest cost. What is helping us here, because we have a fair distance that we're discounting back, is that the discount rate is overpowering the increase in the interest expense, which would lower our pension cost. And what do we have for the service cost? Obviously that'll be lower because we're discounting $10,357 back for each period of time, now at 7%. So our pension obligation is now $80,277.83, significantly lower. So we end up here with a lower beginning pension obligation, we have a higher interest cost and a lower service cost. The combination of these two together gives us a lower pension cost. Higher interest cost, but lower service cost. since we're discounting back over such a large period of time, the discount overpowers the 1 year forward interest cost that we have. We have lower pension cost. Our pension cost at 6%, if you had these two components, was 12,847. Our new pension cost is 12,074. So just a small change in assumptions. Nothing else had to change. We just had to change the assumption of the interest rate. Suddenly we have a much lower pension cost. Well, have a look at the last, where are we, 2000, look at the last 9 years. Where have interest rates gone? Straight down. If an increase in the interest rate has the effect of lowering our pension obligation and lowering our pension expense, what do you think a decrease can do? And we've had significant decreases in interest rates since, let's say, 2007, early 2007, all the way to now, a 10-year period. So you can imagine the effect that it has on a company's pension cost and pension expense and the present value of those obligations. So what we would do here is we have the 77 at the beginning of the period here. We have 77,39423. Subtract the 68,205, and we get 91,88. That's the difference. We've lowered the pension obligation by 91,8877. That's called an actuarial gain. We may even call it an experience gain if it's an actuarial gain if we simply change the assumption of the long-term interest rate that we should experience. It is an experience gain if the interest rate did actually change and forced us not to just keep our assumption in an unrealistic place, but pushed our assumption based on what really did happen. So that would be called an actuarial gain. Now you may think, well, that's got to really suck. In other words, whenever interest rates start dropping, companies' pension expenses start exploding and their pension liability starts to increase dramatically. Yes, but let's flip over to the other side. What typically happens as interest rates drop? Prices rise. When interest rates on a bond, if the pension fund was invested in bonds, and as interest rates started to drop, the prices start to rise, which means the actual return on plan assets would be greater than what was expected. Not only that, risky assets start to rise as well, because lower cost of funds means more people are willing to purchase. The economy starts to expand. That's what we do, and central banks do in recessions, is they lower interest rates to encourage activity. So even though the drop in the interest rate is a negative for both the pension obligation and the annual pension expense, let's not forget on the other side of the ledger we have assets that are going to benefit from lower interest rates, which means the bond holdings and the equity holdings will increase in value at a rate faster than the expected rate. Not only that, if it's IFRS, I really want to make this point clear, because if you get this, nothing will trip you up on the exam. IFRS, remember, the expected return on the assets must equal the discount rate. So if the discount rate, which is the rate on the 10-year very safe corporate bond, is dropping, that means the expected return on the portfolio is dropping right when the actual return would be increasing dramatically. So there is an offsetting effect built into IFRS that in periods where you have the actual portfolio underperforming the expected portfolio, when rates are dropping, it would reverse. They'd reverse each other. So this is we need to remember that, yes, lowering the interest rate has a negative impact on a company's pension obligation and their pension expense, but it has a significantly positive impact on the actual return of their plan assets. So you kind of want to look at the whole picture and not just one side before you go, ooh, lower interest rates, that's got to suck for a company, right? All right, let's make or look at some adjustments for some of the items reported in the financial statements. And we have a couple of big issues that we need to look at to determine how we approach our analysis of these things. Number one, differences in key assumptions. So we can look at a number of companies in a peer group. Let's say there are 3 or 4 companies, and we can look at the assumptions they made to see which ones are, if there's an outlier, if there's one that's using assumptions that allows it to really reduce its obligation and really reduces expense, or there's another one where their assumptions result in them having a significantly higher obligation. So we'll look at an example of that. Differences in assumptions. Number 2, periodic pension costs recognized in P&L may not be comparable. And we looked at the difference between IFRS and GAAP here, immediate recognition under IFRS versus defer and amortize option under GAAP. Number 3, reporting differences between GAAP and IFRS. This is recognition differences. These are reporting differences. Affects where on the statements specific line items appear. And some cash flow reporting differences between IFRS and GAAP. IFRS financing or operating activities could be affected by pension expense, whereas GAAP, it's all in operating activities. So we're going to see what happens when IFRS decides to use both categories and how we can adjust GAAP for the same thing. Okay, so let's have a look at these assumptions. And the assumptions are disclosed. They're in the notes to the financial statement in the proper section. And we'll get assumptions on the discount rates, the expected compensation increases, medical expense, inflation. For GAAP, the expected return on assets that they're assuming will occur. For IFRS, the expected return on assets is the discount rate, so there's no big deal there. We're also going to get a lot of assumptions about other post-employment benefits, the big one, of course, being healthcare. So increases in healthcare costs over a period of time. And we're going to get assumptions about what they think the future inflation rate is going to be in healthcare. And that future inflation rate is known as the ultimate healthcare trend rate. That's what it's referred to. So if you see that language, you know exactly what it means. It's some future long-term trend rate in healthcare inflation that would be different from the current rate of inflation. The current rate of inflation might be higher, and we're projecting it to be lower in the future. So if we have higher near-term costs, so that our healthcare inflation rates are higher in the near term, higher ultimate trend rate, that if we feel that the trend rate, one company has a higher ultimate trend than another, and a longer time to reach that trend rate, that company will report higher periodic costs. So we have 3 assumptions in here, right? There's an assumption about what near-term inflation, healthcare inflation will be. There is an assumption about what the ultimate trend rate will be, and there is an assumption about how long it will take to reach that particular trend. Okay, well, let's have a look at an example, and I think there's a good one in the curriculum here. I've reproduced the two tables, and we'll just walk through and think about how we would look at this from the eyes of an analyst. And let's make sure we know what we're looking at first. It's always important when you look at tables. Get a good idea of exactly what's being presented before you start looking at numbers. The assumed discount rates used to estimate pension obligations. So these are the assumptions that are being made. We see that we have 2005 through to 2009. And we have Fiat, Volvo, GM, and Ford replicated twice. The top part is for non-US plans, and the bottom part of the panel is for US plans. So great, let's have a look here. So when we look from 2005 through to 2009, we can see a Fiat here at the top, that their discount rate has been increasing each year up to 2008, and then decreased in 2009. When we move over to Volvo, 4, it increased to 4.5, held steady at 4.5, then dropped to 4. GM, 472, all the way to 622 by 2008. That's 150 basis points up. We look at Ford, 458, all the way to 558. That's 100 basis points up. So let's just take a minute and think about this period of time right here. What would be happening to their pension obligation over that period of time, and to the service cost and interest cost component of pension expense? Well, if you're discounting your future obligation at a higher discount rate, you can effectively lower that pension obligation today. And not one company was doing it, but all 4 were showing increasing increasing assumptions about the discount rate to be used. That will also lower the service cost component but raise the interest cost component of your pension expense. If they're discounting back far enough, it will result in lower, over these years, 2005 to 2008, these companies may have been reporting lower pension obligation and lower pension expense. At the same time, they might have been reporting improving debt equity ratios and improving net income margins. So we have to think, well, how much of that was associated with the assumption of the higher discount rate? Going into 2009, they all dropped, which is a reflection of reality. Interest rates into 2009 dropped, except Ford. What's going on with Ford there? 558 to 593. So we have a little anomaly here, and we'll just put a little footnote on this and we'll revisit that. Let's look at the U.S. plans, and we can see sort of a different sort of trend. If we start at the bottom with Ford, 561 to 625, only 60 basis point increase here, whereas it was 100 basis point for non-U.S. Even though when we look at the U.S. plan, 6.25, non-U.S. 5.58, there's still a question of why is this higher in the U.S., but there it is. When we look at General Motors, we also see that it's fairly in line for General Motors, 5.7 to 6.27. They started off at a higher amount than they did in their non-U.S. plans, but 627 is comparable to 622. Look at Fiat, 510 is comparable with 510. And Volvo is not really aggressive, right? 575 barely increased. 575 to 625 gave a range significantly higher than non-U.S. plans. So we might look at the U.S. plans and the non-U.S. plans and say, well, maybe Ford is not really an anomaly here that they're higher. On its own, if Volvo were actually significantly lower, if they were closer to the 4.5, I'd be looking at Ford and saying, perhaps Ford has more American employees and is using a higher rate for their U.S. plans to report a lower pension obligation than they have in the rest of the world. But it looks like it's fairly consistent across the group, so we can accept that. Let's look what happened from 2008 to 2009. Fiat and Ford both increased their discount rate for U.S. plans, while Volvo and GM decreased. Now, if I'm going to compare them and I want to ask questions, I'm probably going to say, well, I think GM and Ford are probably closer together in comparability. Why would, and we look at the GM drops, how much? Almost 75 basis points, really. Whereas Ford increases by 25 basis points. That's a spread of 100 basis points between the two companies on their assumptions. I'm starting to wonder what's going on with Ford. Okay, so let's have a look at the lower panel. Let's make sure what we're looking at here. Assumed annual compensation increases used to estimate the pension obligation. So this is, the top panel is what we were discounting back the future obligation. This is our current salaries and what we're assuming they'll increase at to get to the final number. And of course we have the same thing, the non-U.S. plans and the U.S. plans. When we look at the non-U.S. plans, we can see 2005, 6, 7, 8, they were all increasing for Fiat. For Volvo, fairly flat. For GM, yes, it has been increasing. And for Ford, it's been decreasing. Well, what happens when you increase your assumption for annual compensation increases? You will increase the future value of the pension obligation, which will increase the current value once you discount it back. But Ford is going the other way. Ford is saying, no, we're going to actually have lower annual compensation increases. Being that GM and Ford probably face the same union, I don't know that this really makes a lot of sense. But there it is. When we look at U.S. plans, we can see that Ford has been fairly constant, fairly flat at 3.8. GM was 4.9, all the way up to 5, all the way up to 5.25, while Ford was not increasing. Ford was not increasing at 5 and 3.8, and then GM brings it down to 3.94 and 3.8, and of course Volvo was fairly flat there as well. So there's some differences in the assumptions being used here. Now here's what I want to draw your attention to. Ford is increasing its discount rate for non-U.S. and U.S. plans, while it has been decreasing the amount that it's going to raise its compensation by. So if I were going to red flag something, I'd red flag Ford with a few questions saying, hey, you know what, I've got some questions because there's something not consistent here. If interest rates are rising, if you're assuming that interest rates are rising, they typically rise. Central banks typically raise rates to combat inflation. If there's inflation, there should be wage inflation. But Ford is over the years, their assumptions has been that interest rates are reflecting inflation, but wages are reflecting deflation. There's something wrong in there. That doesn't mean there's something there. It just means that I got a list of questions that I need answers to. Because I don't know, and I'm not going to assume something's going on. And as an analyst, that's what you would do, is you would dig through things until questions show up, and you'd write those questions down saying, I got to know the answer. But we're not going to come up with an answer on our own. We're not going to say, this is what's going on. This is wrong. You got to talk to management, get their side of the story, and you push them on it. You say, well, what's the basis of this assumption? What's the basis of that assumption? There could be very good reasons for the difference in the estimates. Very good reasons. One of the ones up here, if we're looking at the discount rate, one of the assumptions could be that the differences reflect differences in the timing of obligations. The discount rate, remember, is tied to an investment-grade corporate bond. But typically you would match the tenor of the bond with the tenor of the liability. So if you have the timing of your liabilities are 10, 12, 14, 16 years out, you would try to match the discount rate of those future obligations with that type of, with whatever rate is associated with a bond of that duration. Perhaps Ford has different timing on its obligations. That's one answer that could explain the difference. Maybe it's using a different type of staff in arrangements like this. Maybe it could be a situation where, especially when we look at the U.S. plan compared with Ford and GM, it could be that maybe GM is management heavy up here. And of course, management is getting increases at a rate faster than the union is. That's the a reward for staying in school and doing the right thing, right? So this could be reflecting a management-heavy company, whereas Ford could be reflecting a very lean company, and the 3.8 could just be a true union effect in this, whereas the difference between Ford and GM might be that GM has the union effect plus a heavy management effect. That could be it too, which would make Ford an even better company in that respect compared to GM at that time, right? So just because we see something doesn't mean it means what we see. It means that, listen, what could possibly explain this? Can I find evidence to support that? And if I can't, I got to have a conversation with somebody inside. So let's look at another one about assumptions about healthcare costs, and we'll just go through a few things that we would want to look at when looking at a table like this. The first thing that I like to do when I look at tables like this is just take a few seconds to get the geography down. What am I looking at here? What's the title here? Panel A, Assumptions and Reported Amounts for U.S. Post-Employment Healthcare Benefit Plans. All right, these are U.S.-based plans, and these are assumptions about the costs. Great. We have two companies here. In the first part, I'm looking at assumptions about my healthcare costs for CNH Global and CAT. I know that they're both U.S. based at this point. That's what it's telling me. And the initial healthcare trend rate, CNH Global is at 9%, CAT's at 7%, so it's lower. So I know right away, dollar for dollar, CAT will have lower healthcare costs because their assumption for the increase is lower. So their post-retirement benefit plan for healthcare will show a lower cost in this period, dollar for dollar. I don't know in aggregate, because CAT may be a much larger company, so in aggregate they got a bigger number, but dollar for dollar I know they'll be lower. There's no difference in the ultimate healthcare trend rate that they're projecting. But again, when we look at the ultimate trend rate when we get there, CAT is sooner. So I know that dollar for dollar that will result in CAT showing a lower post-employment healthcare cost expense. So the two added together, I'm looking at CAT and I'm saying, well, you've got two things in your favor right away. Is that the right number? And CNH is just being really, really conservative because they're a smaller company. And since they're a smaller company, maybe it's not a big number for them. And if it's not a big number, they can be a little bit relaxed on those and tighten them up later when they get bigger and it matters. Maybe. I don't know. Who's at fault here, right? So they're sooner to trend and they got a lower rate. I look in the lower part here. And it's giving me kind of a nice analysis to let me know what's going on. Here's what would happen for a 1 percentage point increase in our healthcare, in our assumptions, and a 1 percentage point decrease in our assumptions. So if I say, well, let me right-size CAT with CNH. Let me go from 7 to 9%. That's a 200 basis point increase. If this is what happens after 100 basis points, I can multiply it by 2 and say, well, if CAT did assume 9%, that would make their obligation $440 million higher and their annual expense $46 million higher. It just, that might be useful. It might not. I might come to the conclusion that being that CAT is a much bigger company, maybe they have a special relationship with a health service provider that allows them to get that kind of lower cost. Questions. That's what I'm coming up with, right? When I'm looking at these things, I got my notebook on the side and I'm writing down questions that I want answers to. I may find all of those answers as I continue on through the table and the notes. I don't know. But that's the currency of what I'm doing, is if I'm going to be good at what I'm doing, I need answers to questions. My job is to come up with all the questions that I need answers to, and then go find those answers. Once I have the questions, there's my task. And there's the structure that I have. I need answers for this, for this, for this, for that. Management will be able to help me out a lot on that. Let's have a look at the effect on ratios. This might be important depending on the analysis that you're doing as well. And I've said this before, I'll say it again, that there is no formula or formulaic way of approaching an analysis of a company. It really comes with experience that in some situations this type of analysis is important, whereas in other situations it's not, but something else is important. That just comes with experience. So what you need to do is just realize all the different ways you can look at something and then determine later on what works for you. But we are given numbers for liabilities, equity, and an initial debt equity ratio for both CNH and CAT, and I've replicated them. They look like this. We'll make the assumption that the liability numbers here are the appropriate numbers to do a debt equity ratio on. And this is what we get. And let's look what happens if there's a 100 basis point increase in this assumption for both companies. In other words, CAT will go from 7 to 8, and CNH goes from 9 to 10. Each will get 100 basis points above where they are, because that's the analysis that we have down here, right? Well, nothing here affects the asset. We have an obligation and an expense. So if the obligation increases, the equity would have to decrease as a result, right? So for CNH, it goes from 398 to 504, and this will go from 810 down to 704 on the debt equity, which changes the ratio to 2.462 from 2.408. And for CAT, we do the same thing. We get to 5.923. So if we wanted to look at the sensitivity of these numbers and how it would affect the ratios, we can certainly do that sort of analysis. Again, whether this yields anything profitable for you as an analyst, it depends on the situation you're in, the company you're looking at, and the experience you've built up. Maybe it leads to nothing important and nothing significant and it's uninteresting. Maybe it's interesting. I don't know. So continuing on here with the issues that can affect comparability, we've already looked at differences in key assumptions, went through some examples. Let's look at the net pension liability or asset, and you may think that that's probably the most comparable because it tells us what the funded status of the pension plan is. IFRS and GAAP both have the amount on the balance sheet as net. So we have the net pension liability or asset, and the rationale is, look, there's a pension obligation that we owe, but there are assets that we have, so we don't owe the whole pension obligation. We have assets segregated for that purpose. It's really just the difference that we're on the hook for. All right. We can still find the gross amounts for pension obligation and fund assets in the notes, and they are not consolidated since the plan is a separate legal entity, especially if the plan accepts contributions from both the employer and the employee. Then the company can't get anywhere near that plan. If all of the plan assets and all of the funding in the plan is just the employer itself, then if it's overfunded, you do have the ability, or the corporation has the ability, the company has the ability to do a reversion of funds or a lower contribution in the future. But it's not consolidated, and it makes sense that it should not be consolidated, because if the company disappeared, those assets are untouchable. They're bankruptcy remote from the main firm, and since you have that bankruptcy wall up, it makes a lot of sense not to. But there is an argument for doing so. And let's see if I can make that argument for you here. Let's take a company that has assets, and we'll take liabilities here, assets of 200, liabilities of 40, and equity of 160. So 200 and 200. If we look at a debt equity ratio here, we would have 40 over 160, or 0.25. And let's say that there is no pension liability or asset, that the pension obligation exactly equals the fund assets. But that the pension obligation is 1,000 and the fund assets are 1,000. Let's see what happens if we did include that in. Our assets would increase by 1,000, making that 1,200 on this side, and our liabilities would increase by 1,000, making that 1,200 on this side. Our debt equity, on the other hand, would be 1,040 over 160, which is 6.25 times. And again, you could make the argument that, well, hang on a second now, that's not really a liability. If you cancel that liability off with that asset, if we treated the fund asset as an indemnification asset, it's the same thing. It's gone. It really shouldn't be in there. And you're right, it's typically not done, but if you did it, you'd see the effect that it would have, because, listen, there's no guarantee those assets will perform the way we think they'll perform, but one thing we do know is that pension obligation will continue to grow at a very prescribed rate. Now let's take a situation where we get into trouble. The economy turns down, interest rates start dropping. Well, when interest rates start dropping, this pension obligation will increase on its own. Actuarial gains and losses, right? It'll start increasing on its own. But depending on the assets that our fund has, if our fund is balanced with 50% debt, 50% equity, it might maintain its value. It might lose some value. So let's just say that our pension obligation goes up by 40 and our asset value goes down by 40. Suddenly we've opened up a liability of 80. The bigger the pension obligation and the assets are, the smaller the move has to be in opposite directions to open up a very big liability compared to the size of the balance sheet that already exists. So what you would want to do for comparability is say, let me look at the fund assets in relation to our total assets. If they're significant, any drop in the asset value, any underperformance on that fund will open up a big liability. That's what you want to pay attention to. So you don't need to consolidate, but you would want to compare the size, just the size of the assets in the fund to the asset value of the company itself to see how significant it is. All right, our next issue for comparability was the total periodic pension costs. We know that in IFRS, some go to P&L, some go to OCI. In GAAP, some go to P&L, some go to OCI. More go to OCI that eventually find their way to P&L, but not so in IFRS. It's confusing. There's a lot going on there. But if we're looking at the income statement, just to sort of compare between a couple of companies, their periodic pension costs for a particular year in relation to, let's say, the size of their wages. We might not find all the numbers we need because some of them may be in OCI. For GAAP, some of the numbers in the periodic pension cost for that year might have been amortized amounts showing up in that year related to previous years. So it's going to be hard to compare. So there is a shortcut way of getting at the net pension liability, the total periodic pension cost. And that's at looking at the net pension liability or asset before considering employee contributions. So here's how it works. We take the ending funded status, we will subtract any employer contributions, and then subtract any beginning funded status. So let me show you how that would work with an example here. Let's say we have a company where we have a $100 liability to start the period and a $150 liability to end the period. The company made no contributions whatsoever, so we can easily see that the total expense must have been $50 for the liability to increase if there were no contributions, right? So our ending funded status is negative $150. We subtract our employer contribution, so we're subtracting 0, and we subtract the beginning funded status, so we're subtracting negative 100, which means we're adding, because that's a negative number, so minus a negative is a plus, and we could see we have 50, negative 50, or 50 with brackets. There's our expense, 50, as it should be. Let's go the other way now. Let's say that we actually made contributions of 75, which brought the obligation down to 25, and it still ended at 150. So it's easy to see that our pension expense for the year was 125. Let's just make sure that that works out on this. So we started with negative 150, and we subtracted our employer contributions, which is 75. We subtract 75. And then from that, we will subtract our opening balance, which is negative 100. Minus negative 100 is plus 100. So that'd be negative 225 plus 100 is negative 125. Did we spend 125? We did. So that's a nice shortcut way to get it. Now, no matter where the components of this 125 are, in OCI or in P&L, it would have had to show up in the liability anyways. So if we just take the change in the net liability or asset and reduce it by the employer contributions, we're good to go. All right, the next issue that made comparability difficult, number 3, the reporting differences between GAAP and IFRS. And this is where the costs are recognized, where they're reported. And I've just done a sort of a brief reminder here. IFRS P&L is past and current service cost and interest costs go straight to P&L. Actuarial gains and losses go to OCI. No amortizing permitted at all. GAAP is all over the place, isn't it? The current service cost goes to P&L, but the past service cost goes to OCI and then is amortized to P&L over some future service period. We don't have an interest cost. We have an expected return. That goes to P&L. So if these two numbers are different between the two companies, if they're the same, then there's no issue. But if they're different, well, then they're not going to be comparable. And actuarial gains or losses go to OCI, just as with IFRS. However, if we're using the corridor method, remember, if the cumulative amount is greater than 10% of either the higher of either the pension obligation or the total assets, then you do have to amortize to P&L. So a lot more can show up in P&L because of this, and a lot less can show up in P&L because of this, depending on the timing of all of these different costs. So if you're looking at an IFRS company and you figured out its pension expense for the year, and you're looking at a GAAP company and you figured out its pension expense, but you think that, you know what, the net income figure is not comparable because there are components of the GAAP pension expense that are all over the place. So what you can do is you can adjust the GAAP net income, past service costs for the period. You can reduce net income by that much. So let's say that during the course of the year there were past service costs of 1,000 that went straight to OCI. IFRS would have sent it to expenses, thus lowering net income. So you can do that, and you can lower GAAP net income by any past service charge for the period. And let's just jump all the way down to this last line before we look at the middle. And then what you would do is you would back out any charge in P&L for amortization from previous periods because of that. And finally, you'd make an adjustment. You'd add or subtract an adjustment between the expected return versus the interest cost. So you'd recalculate what the expected return would be if it used the interest cost, the same interest cost for discounting as it does on the expected return. An easier way to do it, you could just use total comprehensive income, because no matter where you send it, P&L or OCI, total comprehensive income is going to end up looking exactly the same. So you could just compare the two companies based on total comprehensive income. So if there's a reason why you want net income, if it's significant, if it's something you need to pay attention to, then you'll make that step. If you're just looking at earnings power and you want to go right to comprehensive income, you can avoid all of the adjustments that you need to make. So beyond just where we send the cost, whether it goes to P&L or OCI, even within all the P&L expenses, pension expenses are generally treated as operating expense, but the interest expense or interest income may be better treated as a non-operating expense. So let's be clear what I'm saying here. When they're sent to P&L, when the pension costs are sent to P&L, and you know there are components of the pension cost, there's the service cost component, which makes sense that should be an operating cost, but there's also the interest cost based on the outstanding net liability or net asset. And there's an argument that probably is better looked at as a non-operating cost as opposed to an operating cost. It depends on how you want to think about it. There's no rule that says it is or it isn't. It's how you want to think about it. And if you think, you know what, those interest expenses, they're better treated as non-operating, I want to get an idea of what the operating expenses are, so I'm just going to consider the service cost and not the interest cost, then you'd want to make an adjustment for that. You would reduce operating income by all components of pension expense except the current service costs. In other words, anything other than current service costs, you're going to get them out of there. Then you'd increase the interest expense by the interest component, and you would increase interest income by the expected return, or if we're talking about GAAP, the expected return, or if you're talking about IFRS, the expected return is the same as the interest expense. Further, a P&L, IFRS, and GAAP includes expected return, so we can adjust that to reflect actual return. So there's quite a few things that we can do. So we're going to look at an example where we actually do both of these things. We're going to adjust we're going to move the interest expense into the interest, or the interest component into interest expense, the expected return into the interest income, and then look at taking that expected return and seeing what happens when we say, well, let's look at it in terms of the actual return instead. All right, so let's set up our scenario. Let's say that this is a sort of a small income statement. We have revenue, operating expense, there's our operating income, our interest expense, our interest income, we have a share of associates, and our profit before tax, $29.29. And in the notes, we find our current service cost was 11, our interest costs were 39, the expected return on plan assets is 14, so our periodic pension expenses that we'll recognize is 36. We actually saw 47. So I have number 1 down here, then we'll do 2. I just did it backwards because I need more room up here to solve number 2. So let's adjust the profit before tax for the actual return versus the expected return. And this couldn't be easier. What is our actual return here? Our actual return, if we would have put in 47, we would replace the expected return, which is 14. We've already claimed 14, but it's 47. So it should be 33 higher. So profit before tax is the 29.29 plus our 33 would be 29.62. 29.62 by adjusting it for the actual return. Here what we're going to do is we're going to reclassify as all of our pension costs here as either operating expense, interest expense, or interest income. Now when we do this, we are going to use the actual return. When we're reclassifying, we're going to use the actual return and not the expected return. And this is easy too. You just follow along. Is revenue affected? No, it stays at 18,020. What about operating expense? Well, it's 15,401, but everything is in there. All we want is the current service cost in there. So what we need to do is we need to make some adjustments here. We have 36 in there right now. We only want 11. The easiest way to do it is to add 36 back to take out all of the costs. So all of it is out. and then we take out the 11 that should be in there. So since these are our operating expenses, we're going to reduce our operating expenses by adding back the 36, that's a negative number, and then taking out the 11. And that will give us 15,536. No, 376. 15,376. So our operating income is 2644. Great. Our interest expense is 879 right now, but we're told down here it's 39, so we would subtract another 39 for interest expense, because this is negative already. 879 minus 39 makes it even more negative, right? So that'll give us 918. Our interest income is 316. What are we going to do with that? Remember, we said we're going to take our actual amount, so we'd take this and would add the 47 to it, and that will give us 363. 873 stays the same, and you should get 2962, which is the same as adjusting the profit before tax. So if you're only concerned with adjusting profit before tax for the actual, just go ahead and adjust it for the actual. If you're concerned with a measure of operating expense, of operating income and profit before tax, then yeah, you'd want to pull out the interest income, which is the actual return. Well, in this case, it's the expected return. You'd want to pull that out. You'd want to pull out the interest expense and put them in their proper categories. All right, the last issue we want to talk about for comparability being affected is the cash flow impact. And for cash flow impact, the only impact we have are the employer's contribution to the fund. The pension expenses that we incur, those are non-cash expenses. They will be cash expenses at some future point in time. Whenever we pay benefits to to employees who are already retired, those payments come from the fund. They come from the fund assets. The fund is responsible for making sure it has enough liquidity on hand to meet all those payments. So a corporation's cash flow is only affected by its own contribution to the fund. Everything else is non-cash. If the contributions to a plan in a given year are in excess of the current pension expenses, we can think about it as kind of like prepaying a loan. That every year there's pension expense and we must make a contribution equal to that pension expense. If we pay more, it actually reduces the pension obligation. So while it's not equivalent, while it's not the same thing as prepaying a loan, it is economically equivalent to prepaying principal on a loan. So let's just have a look at an example here to see what effect it would have on cash flow from operations and cash flow from financing, because if we're making the cash contribution that's equal to pension expense, then that is rightly classified as an operating cash flow. But if we're making a contribution in excess of the pension expense, maybe that excess is better classified as a financing activity, because if it's economically equivalent to prepaying principal on a loan, if we did prepay principal on a loan, that would be a financing activity, right? So let's take a situation where we have our total pension cost for 20 whatever year you want to put in of 437 million. We contributed in that particular year 504, so we contributed 67 million more than we needed to. Our cash flow from operations we reported as 6161. Cash flow from financing was an outflow of 1741. We have a tax rate of 28.7%. So since we contributed 67 million more on an after-tax basis, that's 48 million. 48 million. So our cash flow from operations, we can increase by 48 million to 6209, and we can adjust our cash flow from financing downwards by 48 million to 1789. So I imagine a question at this point is, why would a company contribute more than it had to? Especially when we consider that cash flow from operations is such a prized number for companies. Why would they? Why would it make sense for a company to contribute more to its pension obligation than it needed to? Well, let's think about why a company would prepay a loan if it didn't have to. Because it made it made sense from a financial perspective to eliminate the interest expense associated with that portion of the debt. It was a wise choice of money that was lying around that probably didn't have a better investment on hand. Well, let's think about the assets in our pension fund. We know that every year we're going to have to make contributions to this pension, to the plan assets, and that our pension obligation will continue to grow. But there are times where we might say that the market is extremely undervalued at this point in time, that a very good investment to make would be into the plan assets simply because its growth would eliminate any future or reduce any future contributions that we have to make. So if we find that the market is in a good place to make a good investment, the plan assets are an investment that will reduce future compensation or future contributions that the company has to make in the future. So there could be a corporate finance case to be made for over-contributing to a plan in a particular year. Well, if the company has to be penalized for that by reporting it all in cash flow from operations, they might not take advantage of it because it might hurt a key metric. So that's when they would say, look, in the cash flow from operations, here's what we had to do. The rest we'll put in cash flow from financing because it will reduce. If we're right and these assets really perform, the actual return will be greater than the expected return. It'll move us into an even more overfunded position, or maybe from underfunded to overfunded over the next few years, and reduce the cash outflow that we need in later periods. So there is a case to be made for paying in excess. Why do I spend time explaining that? Is because I get that question when I actually do this in a class. I do get that question of if corporations are so efficient at their cash flow, why would they ever overpay? And you have to make the case that, well, think about it as just another investment project that has some net present value to it. If we put in a big payment today and the actual returns are much greater than we think, what's the effect on our future contributions? Take the net present value. What internal rate of return does that provide? And does that exceed our cost of capital? If it does, well, it's just like any other project. Go ahead and do it. All right, we're on our last two learning objectives. We'll do them both at the same time because they're kind of hard to pull apart. Share-based compensation. This stuff is really easy and straightforward. Our salary, when a corporation pays salary or bonus, it's oriented towards the short term, on short-term performance. Long-run compensation typically includes some sort of equity-based compensation or some sort of form of equity participation based on some long-term measures. And what's nice about them is they don't involve the use of cash. If you grant stock grants, outright stock grants, or stock options, you don't actually have to part with cash. So you can compete for talent in the market without actually having to pay the full amount. Equity compensation rewards depend on future events. Therefore, continued employment is usually a necessary element. So most of these awards will have vesting terms associated with them, whether it be 2 years or 3 years. You can think of a situation where a company would hire me as the CEO and give me a stock grant of 5% of the outstanding stock. If there's no vesting requirement whatsoever, the very next day I'll resign. I'm gone. Thank you for the stock and see you later. So if they're going to award me that much stock, they're going to make sure I'm sticking around for a while. So I might have a 3, a 5, or a 7-year vesting where a third vests in 2 years, another third vests in 3 years, etc., whatever the schedule is. But typically there'd be a vesting schedule. Now, that's important. That vesting schedule is important because if I'm awarded $1 million stock grant on day one, but it takes 3 years to vest, that expense is recognized over the vesting period. That becomes the service period. So being that they typically have a vesting clause associated with these grants, that becomes the amortization period for whatever value, whatever fair value we have on the day that it's granted. There are a bunch of different plans to look at. CSOPs, these are called compensatory stock option plans. And that's what I just described. I got hired by a firm as a CEO. I either get stock options or stock grants as part of my compensation. There are direct awards of stock, which we'll look at. SARs we'll look at right at the very end. This is called stock appreciation rights plans. They're kind of like the same thing of 1 and 2, except they avoid dilution. That's all they do. It's kind of like phantom stock. It's like, let's pretend we gave you some shares, and in the end, we'll just cash settle. So number 1 and number 2 are equity settled plans. Number 3 is a cash settled plan. And number 4, you have a performance type plan, which could be a CSOP or a direct award of stock, which instead of awarding you based on some exercise price compared to what the stock price is, it rewards you based on some key accounting metric that you reach because, well, that's more in your control than the share price, right? So when it comes to share-based compensation, there are 2 big issues that have to be dealt with. Number 1 is recognition. When should the cost be recognized? And number 2 is measurement. How the cost should be measured, or how should it be measured? Here's the problem. If it's outright stock grants, if we're dealing with just straight stock, that's easy. How do you measure it? Look at the price. Look at the price in the marketplace. Simple. If it's options, there is a difference between exchange-traded options and options issued by a company. Options issued by a company do not trade on an exchange. They are not separable. The ones issued by the company for either the employee stock option plans or the compensatory stock option plans do not trade on exchanges. And just a quick difference between the two. The employee stock option plan, these transactions are seen as capital transactions. For the compensatory stock option plan, since it's an alternative way to compensate, they're charged to operating income on the income statement. Any employee stock option plan, if you're an employee, you may have the right to participate in the stock option plan. These are charged to equity accounts. They don't show up in operating income because they're not part of your compensation. They're just an extra benefit for being part of a company, and it's a great way for a company to continually raise money because if you exercise your options, you got to pay the strike price to the company, right? So for the compensatory stock option plan, since it is an alternative way to compensate, it's charged to operating income. Several disadvantages of share-based compensation have been pointed out. Number 1, management usually has limited influence over the share price or the market value. Hence, it's not as relevant as it could be. That's why there is the performance type compensation, or the performance type award, as opposed to the share-based type award. Second point, ownership may lead to risk aversion. That once you start owning shares of the company, you may get a little bit more risk averse. If a lot of your income is tied to the share price, if you have an elevated share price, you might say, hey, let's just kind of coast here until the end of my vesting because this is a good price to have right now. By the way, if you have stock options in a company and the stock price is quite high, even if you're vested and you can't exercise for another 2 years, you can still lock in that price by having a broker short the shares for you and putting your vested shares up as collateral against it. It still can be done. It was done a lot in the late 90s, early 2000s by the .com CEOs who immediately locked in their gains off the IPO by having a broker short the amount of shares that they were vested for. So it can be done. Whether it's ethical or not, you have to decide that, but it can be done, and it's done. It's done. If it can be done, it will be done by humans, period. It's not a matter of, well, it's not ethical, nobody's doing it. Oh, yes they are. IFRS and GAAP. Let's get on with our share-based compensation here. IFRS and GAAP. The fair value of any share-based compensation that's granted, that's what the compensation expense is. Whatever the fair value of the share-based compensation is, that becomes the compensation expense. The fair value depends on the type of compensation. So let's look at CSOPs first. Fair value is calculated on the date the options are granted. And the grant date is the same as the measurement date. Whatever date they're granted on, that's where we measure the fair value of the options. After that, no adjustments are made after the grant date for any changes in option value. So if you're buying exchange-traded options, and let's say that you're a company and you're buying options on something and you're holding them on your balance sheet as a financial asset, you know that every period you have to report them at their fair value, which means there are subsequent changes. In this situation, when these are recorded as a compensation expense, that's it. It's done. Whatever the fair value of those options you gave up that day, that's your compensation expense. Why are they not adjusted? Well, because they're not yours anymore. You gave them to the employee. That is the employee's option to exercise or not. The employee on their own personal balance sheet can list them at fair value if they want. But as far as the company is concerned, they don't own those options anymore. They belong to the employee. So they're measured at fair value on the grant date. They're recorded as a compensation expense. No other further adjustments for any changes in value of the option are recognized after that. So let me put a timeline up so that we have all of the language down so we understand what all these dates are. The grant date, that's the measurement date. That's the date that we actually granted somebody options. There may be a vesting period. From the grant date to the vesting period, that's called the service period. Costs are allocated over this period. So let's say this were 3 periods and the grant date to the fair value of the measurement at that point in time was $300,000. We would record $100,000 per year over the next 3 years for compensation expense. Anytime after the vesting date, you have exercise dates. So I put 2 nodes here for exercise dates, but it could be at any time exercise. And various dates, you don't know when it'll be exercised, but there is an expiry date. Typically for options that are used as compensatory stock options, the expiry date is typically 10 years. They're 10-year options, sometimes 5, but typically 10-year options. They're very long-dated options. If vesting is immediate, the measurement date is also the allocation date. So if there was no vesting and the grant date, the fair value of the options granted were $300,000, it would be recognized right in that period. If stock options are not exercised by the expiry date, what do you think happens? Do you think that it's reversed? It's not. The costs are not reversed. Why not? Again, remember, once you grant those options, there are no subsequent changes that you make. Once you grant those options, you part possession. Means the options belong to the employee now. It's their right to exercise it or not. If it expires worthless for them, well, too bad for them. We still delivered on the grant date. We still delivered something that had a fair value, something that had a positive fair value. So we would still record it as an expense. Once we record an expense and we give it away, that's it. It's done. If it doesn't work out for the employee, well, then that's too bad. Think about it this way. Let's say you painted my house, and in exchange for painting my house, I gave you a car. And I record the expense of the car. And let's say that you don't drive the car and something happens to the car, it's totaled, it's destroyed, and you didn't have insurance on there. Do I reverse the cost of the car simply because you didn't extract value out of it? No. Once I part with possession, once I pay you for your service, something of fair value that you agree on, what happens to the value of that asset after, that's on you. So, the fact that an option was not exercised does not mean that some compensation with some value was not made. On the grant date, the company did grant something that had value for the employee receiving it, otherwise they wouldn't have agreed to it. It did have a service period over which that cost was allocated. It expired worthless. That's the employee's issue. It's not the company's issue. Now you may say, but hang on a second now. We parted with something, the corporation parted with something that didn't cost anybody anything. It didn't cost an employee anything. It didn't cost the company anything. It cost nobody anything. In fact, the company made out great simply because the employee provided services far in excess of their salary. Yes, you can make that argument, but here's the other side of it. Again, once you gave it as compensation, it is no longer yours. It belongs to the employee. The changes in value of it are not on your balance sheet. So we have recognition. Let's look at measurement for stock options. It should be not surprising at all that it requires a valuation model, either a Black-Scholes-Merton or a binomial pricing model. We don't really need to get into that here, but we have seen these pricing models before, so we should know how to price one of these if we have the right inputs. And our inputs are exercise price, expected life of the option, the current price of the stock, the volatility of the stock, the expected dividend yield, that's an iffy one, right? And the risk-free rate. Notice this is not the expected dividend, it's the expected dividend yield, which means you have to have some sort of assumption about where the dividend is going and some assumption about what the price is going to do as well to come up with the expected dividend yield. The longer the life of the option and the higher the volatility of the stock, the higher the fair value will be, the higher the compensation expense. The higher the expected dividend yield, the lower the fair value will be. So there are some assumptions in the measurement model, and if you look at the disclosures that a company makes when it prices its options, it tells you what valuation method it used, and it tells you what assumptions it used. So that takes care of stock options. Stock grants. There are three types of grants we'll look at. An outright grant, number one. It's called a non-monetary reciprocal transaction. Why? Because it doesn't require any money, and it's a reciprocal transaction in the sense that we're going to grant you some stock and you're going to grant us your services. So it's in accounting terminology, it's referred to as a non-monetary reciprocal transaction. If we expense this, what do you think we do in cash flow? You got to take that out, right? Keep that in mind now. You got to take this stuff out because it's non-monetary. It's non-cash transactions here. So on the stock grant, the fair value is whatever the stock price is on grant date. That's the fair value, and it's allocated over the service period, just like it is with options. It would be rare that somebody would just be granted unrestricted outright stock. So we'll look at restricted stock now. The employee forfeits stock if certain conditions are not met. So instead of an outright grant, I'll say here's a whole bunch of shares. They're yours for a period of time. Here are the conditions that have to be met. Here's the time in which they have to be met. So that's why they're called restricted. If those conditions are not met, you don't get them. And those conditions could be based on tenure, so many years, vesting, or performance. Certain measures need to be reached. How do we account for this? The fair value at grant date is the price, whatever it's trading in the market at a grant date, and again, allocated over the service period. It's the same for no matter what share-based compensation we're looking at, it's the same thing. Fair value on grant date, allocated over the service period. It's part of compensation expense. It goes right to operating expenses. Look at contingent grants, moving from restricted to contingent grants. These are called performance shares, usually based on non-share price measures like ROE or ROA. Again, accounted for the same way. The argument for the contingent grants over the stock options or outright awards is the CEO probably has a limited impact on the actual market value of the company, but it has a lot more control over other measures, accounting measures such as ROE, ROA. So tying your stock grants or your option grants to something internal, the CEO has much more control over that. But that being said, so does accounting. Accounting has a lot more control over getting to these numbers as well. There's always a trade-off, right? All right, let's look at some of the disclosures required for share-based compensation. As I said before, the valuation model used must be disclosed. The inputs to the model, including all assumptions, will be given. The number and value of options issued, exercised, forfeited, and expired will also be given. And total compensation cost in net income and contributed surplus. So that's kind of a funny thing, contributed surplus. What's going on there? It's hard to understand how this stuff is spread out over the statements unless we understand the transactions. So let's just look at a few journal entries of how this stuff would be recorded, and you'll see what I mean. Let's say on January 1st, 2015, options on 10,000 shares are granted with 2-year vesting, and the options have a fair value as of January 1st, 220,000. What would be the accounting transaction for that? Well, compensation expense would show 110 right away. We get that, right? There's the 110. Contributed surplus has the other 110. Sorry, not the other 110. The other side of the transaction would go to contributed surplus. So you have a debit to compensation expense. Your credit entry is to contributed surplus. So when we look for disclosures, the total compensation cost in net income and contributed surplus, There it is right there. So we can see that it's in contributed surplus. So now the question is, well, how does it get out of contributed surplus? Let's have a look at that. So on June 1st, let's assume 2018, 20% of those options are exercised at $60. So 20%, so that means 2,000. We had 10,000. 2,000 are exercised at $60. So we're going to get cash of 120,000. That's the whole idea behind options, is you got to pay the exercise price. We get cash of 120. Contributed surplus, remember there was 220,000 over the 2 years that would have ended up in contributed surplus. 20% of it can now leave. So 44% comes out of contributed surplus, and 164 goes into common shares. Why? Because we gave up that much to begin with. That was the fair value of it, and then we received that much cash after. That shows up in common shares. So what is left in contributed surplus? It would be the 220,000 minus the 44,000 is the share-based compensation that's still left in contributed surplus. So it's easier sometimes when you see the accounting transactions that would account for the transaction itself to figure out where everything happens to be sitting, right? Finally, we'll end with SAR, which is a stock appreciation right. Sometimes phantom stock satisfies the same purpose. The compensation is tied to the value of the shares without the need to issue shares or options. It avoids dilution, and they are cash settled as opposed to equity settled. Cash settled share-based compensation, and that's what an SAR is. How do we account for it? Fair value at grant date, allocated over service period. So as far as where all of this goes, it all goes to operating income. It's all valued as of the grant date, and it's all allocated over the service period, no matter what the form of the share-based compensation is received. It's accounted for in exactly the same way. That ends this chapter.